Indonesia, China, Philippines, I mean, all over the place out there. So he designs furniture, he builds furniture or manufactures furniture. And so, but he's had two different products that he basically developed that were on Shark Tank. So if you guys ever seen Phone Soap or the Urban Garden, My Urbio, it's like it just goes back to stocks like, for example, like Nvidia, right? I mean, I'll just kind of bring this up and then we'll get to our topic today. But take Nvidia, for example. Can Nvidia make an actual graphics processor? What do you think? Is Nvidia actually capable of manufacturing anything they design? What do you think about that? Is Nvidia capable of manufacturing anything they design? Tim in all caps says no. Rogbro says no. Right. They have no capability of manufacturing anything. They just spent $20 billion to buy a company called Grok, right? GROQ, but they don't. Okay. Why do they need to manufacture? Well, that's the whole point. How is a company that designs something that has no capability to manufacture worth $4 trillion? Apple. How is a company that has no capacity to manufacture? And they've tried. They tried to do a car, they tried to do a TV, couldn't do it. Complete failures at manufacturing anything. Why in the world is Apple given the massive valuation it is when they have zero capability of doing anything with which they propose? So I take into account. I'm like, for example, My Urbio, company that or Phone Soap, for example, My Urbio. Well, My Urbio had no idea. They just designed this little metal wall and these little pot holders, right? Intellectual property. But does intellectual property really? I mean, again, we give out intellectual protection way too easily, right? So Apple comes up and says, well, we designed the curved edges on a phone. So Samsung, we're going to sue you for billions of dollars because you can't do a curved edge on a phone. Come on. Right? But anyway, so this company, these guys just basically, hey, well, we just came with an idea. We'll just put these little boxes on a metal thing and put magnets on it, and there's an urban garden. Well, they had no ability to actually manufacture it. They didn't know what size of magnets, what they'd have to make the boxes out of, what the background. All they have is just a very basic concept. Phone Soap, very basic concept, right? Oh, we'll just use UV light to clean a phone. No idea what it would take to produce it, to a price point. So my brother those are two companies that he came in and basically designed it for him, right? Came in and said, you have an idea? Yes, but I'm going to make it so that you can actually produce a product and sell it. So those are a couple stocks that are on Shark Tank that, but anyway, manufacturing's gritty. You actually have to, you can't just conceptualize it and have no ability to actually produce something, right? So when we say Nvidia's companies were $4 trillion, well, if it was not for Taiwan Semiconductor, where would Nvidia actually be today? Where would AMD be today? If it wasn't for the outsourcing of manufacturing, where would they actually be? Because they do not have the expertise to actually make a product. So, and I don't know, does Grok actually make anything? I mean, is Grok, I don't think Grok's just design. I think they are trying to manufacture, right? But paying what was $20 billion for them. So the point is like, okay, we're not going to invest in R&D. We're just going to buy a company at a massive premium, right? Wayne said, never said how chip designs are given to companies to China and Taiwan for manufacturing. Surprise, because they don't know how to do it. So that's the whole problem is, right? If Nvidia could actually make a chip, they might do it, but they don't. They don't have any ability or knowledge or know-how or equipment to actually manufacture a single product, right? Other than software. But at the end of the day, I mean, they're less on software, more on hardware, and it's going hardware, right? It's going software, right? That's what we find out with Google, right? They're going the TPU structure, and with buying this new company, they realize that their structure is getting old, right? We're going more towards software. I don't know. It's a really interesting dynamic that's playing out right now. And it's just these companies aren't worth what they are. They say, "Oh yeah, but look at all the revenue." Yeah, but where's Nvidia's revenue coming from? Finance, right? They're financing purchases of companies that can't, and their two customers make up what 40% of their business or more. Yeah. So again, it's just not. It just doesn't feel right, right? Apple. Well, yes, Apple's generating a lot of revenue, but again, what are they doing that separates themselves, right? They've created an ecosystem around the phone, but they're not selling as many phones. I don't know. It's interesting, right? And the Chinese have attained chip independence. Yeah, I mean, well, this is the whole point, is right. Chips will be commoditized. Oh wait, Nvidia designs a commodity product that soon will become a commodity product that AMD probably has surpassed in terms of some aspects. It gets interesting, doesn't it? Also, wait, a commodity product. Well, yeah, but what benefit is there to designing a commodity product? Not a lot. So why in the world is Nvidia worth what they are? They're not worth what they are. That's the whole point, right? That's why people say it's a bubble in AI. My brother and I were talking yesterday. He lives in a town about 15 miles south of where I live, and they're going to put in two different data centers, and people are concerned about water because we live in a desert. They're concerned about power, right? And here we are. They're building two data centers in a relatively small community, and the leadership, the mayor, and all the city council members are out there saying, "Hey, this is going to be a huge benefit for us." Well, how? They're only employing maybe 50 to 300 people at one of the bigger data center. 50 to 100 300 people. That's not a lot of people, right? We're talking a town maybe of like 10,000 maybe. So we're not employing a lot of people. We're using water. Oh, but it's self-contained. They're not going to need any additional water for the cooling, but they're also going to produce the power on site. And I'm like, okay, well, what are they going to use? They use natural gas. Well, what kind of natural gas demand is there? And again, if you're going to run a natural gas power plant, you need water. And somehow they're not talking about the water there, but what the water we use for the natural gas power plant will flow to cooling the processors in the data center. And of course, they're saying, we're going to get about a 25% additional property taxes. Well, then it was asked, were you going to reduce our property tax? No, we're going to build a new fire department, right? So these city council members are just salivating because they're going to get two data centers that don't make money. I mean, the entire ecosystem of AI generated what, $20 billion in 2024? ChatGPT, OpenAI is going to generate what, about 15 billion in revenue this year? And that revenue is not really mostly cash. It's credits. It's like the Dumb and Dumber, right? Okay, here's 250,000 for a Lamborghini. You might want to hold on to that one. It's as good as cash. It's not, right? I mean, these credits are not cash. Very little cash exchanging hands in this whole AI boondoggle. And I say boondoggle because most of these companies are not worth anything and never will be. But this is the hallmark of what we saw in the great financial crisis in terms of homes, right? Packaging these bonds together. Go back to the tech bubble in 2000. All these companies that basically in their prospectus said we will never make money, right? 2018, talking about the cryptocurrency craze, right? All these companies said, hey, you buy my crypto, I'm going to basically take that money and I'm going to buy stupid electronics. I can't remember the name of the crypto, but that was what the guy said. You have government support, and that's exactly the problem, right? And said, look, my brother's like, well, yeah, but if they build these data centers and they don't put strain on resources, which they will, okay? But he says, well, what's the big deal if they just go under? I said, well, how much capital is the city committing? And then the other thing, that's when the whole fire department came out. I was, yeah, I said, well, right here it says that we're going to get 25% more in capital gains taxes, and we're going to build a bigger fire department. Well, you know what kind of fire department they're going to build? They're not going to build a fire department for a 10,000 member community or 15. They're going to go over and above because we're going to build a bunch of apartments, right? In our town here in Springville, we had a mayor, and he's like, they employ a lot of people, Clyde Corporation, but this guy's a leech on our community, right? He gives stuff back, but everything they do, his dad was a former governor, so they were really connected in building roads and stuff. Anyway, So he comes there, he's our mayor, builds a huge civic center, a civic center for 100,000 population community, a library for 100,000 population community. Then they want to build a rec center, a big one for 100,000 population community. We're only 35,000, 85% build out. How do you get there? You build a bunch of apartments, right? Take all the farmland. We're going to, but the farmland uses so much water. Really? You put 1,000 people on an acre, whatever that number is, 2 acres, you use more than farmland? No, you don't. Anyway, it's crazy. So the point is that you increase the actual expenditures, the size of that city government, because you bring in these AI data centers. And then what? Well, when they go bankrupt, which is very, very likely, we got over 5,000 data centers in the United States. There's like 550 in China. You don't need that many, right? Oh, we're building a lot of them because we're going to need it. This can be the end of the. It's going back to like 2018, the whole crypto thing, right? You don't think they're going to require at some point to raise property taxes? Because then all of a sudden, suddenly, we have all these increase in expenditures and all these buildings and stuff that we built to ourselves for public use, right? That we no longer have the money to do. Oh, we got to raise your property taxes. Sorry. Okay. Food's only for rich people. I know it's becoming now, isn't it? Right? It's like, used to be, we were talking about my grandma, her home in Provo, like it went to the center of the block. They had kind of her backyard, but then there was all this land behind it where they could grow crops. They could be self-sufficient. Anyway, point being is that when I talking with a builder friend of mine, he's like, yeah, man, if we did not have subsidized water rights from the city, he's like, we couldn't build. Exactly, right? Because these cities come in and sell water for below market value. He's like, even if we could get it. Well, yeah. So if the cities did not subsidize and hand over water rights to developers for way, way below cost, and that cost is socialized across all of the members of the community to pay for that water and higher demand because we're increasing the density. Well, guess what? We would have bigger lots, right? We would have more land to grow stuff if those water rights were not subsidized by the city. And my grandma, I remember she was getting strong-armed in the 70s to sell her water rights to the city. Anyway, forget farming, build data centers. Yes, we're more machine than man now. So, anyway, I'll get off the soapbox here, but this does tie into a little bit of our discussion here on silver, right? We're going to just kind of say what's up with silver. Forgot the question mark there. And then we're going to discuss the magic formula for a new year. I got it down to around 30 stocks. I'm going to show you my process, and we'll look at some of the stocks in terms of how do you evaluate them. I'm going to narrow it down to 10 before the first of the year. And so anyway, we'll talk about the magic formula here, but let's talk silver. Why is there so much silver demand? /SI. We're up 6% today, right? Frequently, you will see significant spikes in commodities ahead of what? When do you see significant spikes in commodities? Let's go to CL. I'm going to go back here to 2020. Max available, not 2020, 2008. Let's look at oil. What happened to oil back here in 2007? So shortages, right? That's the thought process, right? But look right here. What happened to oil back in 2007? What was the thought process at that point in time, right? We had peak oil, right? Oil is now going to become a really finite, limited commodity. We're at peak oil. But what created this massive, massive move, especially right here in 2008? Why did oil prices significantly rise in 2008? So we look right here. This is what? This is January 2008. That's March. That's right. It's April of 2008. So for 2 quarters, 6 months, oil, and right here for in a 3-month period of time, oil went from 100 to 140 plus. Okay. This whole notion that, right, we're short on the supply of oil. That was the whole notion, right? But what was the real driver of oil back here? Does anyone know? The primary driver for oil. Let's bring it by RX. I forgot. Colon CGI. Oops. IRX colon CGI. We're going to use this as a proxy for the Fed funds rate because it's going to be pretty close. Okay. So notice what happened here. Right. So beginning in around April of 2007, what happened? Interest rates were about 5% for 3-month T-bills. And right here on the first quarter of 2008, aligning with Bear Stearns, we went from 3.25 down to about 1.25. The Fed cut rates substantially in 2008. This is pre-Obama, right? This is, the election year was 2008. This is all pre-Obama, right? This is Bush. Fed was cutting rates in 2007 and the first quarter in alignment with Bear Stearns in that February of 2008 timeframe, we cut rates to 1.25%. Okay. So we see Fed rate cuts creating what? A dollar implosion, right? And so what happened was we were expecting, well, we weren't, but the idea is that foreign investors were expecting that the dollar was going to drop substantially. And part of this theory was the decoupling between the US and China. That somehow China would be able to hold up and the US wouldn't. And as a function, the Chinese yuan would strengthen against the dollar. So what happened was people borrowed a significant amount of dollars in anticipation that the Chinese yuan or renminbi would go up substantially, and that appreciated yuan would be able to buy back those pay off those dollar loans for a penny on the dollar. But where did some of that investment go to? It went to oil. This whole notion that what? The whole notion that oil was finite, that oil was going to be what? We were at peak oil. Oil demand was going to go through the roof. China's decoupling. Demand's going to increase. We're going to see the flows, and we're not going to see supplies to be able to handle the demand until when? Until we saw July, and we got hit with Lehman. We were already in recession. Second quarter of 2008, right there. It's 2008, yeah, that was 2007. Second quarter of 2008, right there. We put up an advanced GDP number of 4.1%. An advanced GDP of 4.1%. Think about it for a second. We were in recession. When did they tell us we're in recession? About a year later. They said we were already in recession, yet we put up a 4.1% GDP as an advance, that first estimate in second quarter. So are we seeing something similar happen with that silver right now? Absolutely. What's China doing right now? They're limiting what? Exports of silver. Why? There's a shortage. Why is there a shortage? Don talked about it this morning. Did anyone catch what Don said this morning? In terms of silver? It's pretty interesting. What is driving the demand for silver? Why do we suddenly see? Is this because we're suddenly manufacturing way more silver? No. Wait, so the manufacturing demand for silver is that much high? Sure, we see that people say, okay, yeah, we're gonna make silver solid state batteries. Solid state batteries even a reality? I mean, Toyota Motor Company is supposed to come with solid state battery technology. Well, I think starting next year. I haven't seen them do anything yet to say, hey, here's a and they're actually going towards hydrogen again, right? Banks. Well, why are banks suddenly demanding silver? Why are banks suddenly demanding silver? Why are they saying that JP Morgan, so the Fed's whole QE, not QE, to create bank liquidity was because of JP Morgan and their silver obligations? Certainly there's hype. But the reality is that banks are backing all these products, aren't they? So if we look at SLV today, I mean, Don talked about it, right? The idea that, hey, that the tail is wagging the dog here. We're seeing 770,000 call options, 659,000 put options, 5.9 times the average, 3.9 times the average there. How are you going to hedge silver, right? I mean, if you're going to, people are buying calls, market makers are so, how do they hedge their bets? And Don talked about this morning that /SI, you see that kind of opening gap, right? It's that kind of like big jump overnight. Why? You're having to hedge overnight to cover these positions. So it's financialization that's driving it, right? Isn't it principally? This isn't about bottom line demand. I mean, the fact of the matter is that silver is an industrial metal. Are we really seeing that sort of demand from industry? Or is this potentially a failure in Fed policy? If we look at IRX, for example, CGI, yeah, I'm on my soapbox today, but let's back this out here. What's going on right now? Similar to 2007, we were at 4.25%. We're pricing 3.5 right now. Fed funds rates 3.5 to 3.75. We're already pricing in the next rate cut, right? We're basically down here to 3.5% on the 3-month T-bill. This is going to be pretty well aligned with the Fed funds rate. They're already pricing in the next rate cut and the next probably too. So if we were to bring up here, let me bring up, let's go to Fed Watch here. What are the rate cut odds for January? The futures, what are they pricing in? They're not pricing any sort of rate cut odds in here, right? And yet, where's 3-month T-bills pricing at 3.5%? We're not pricing it in here yet, but guess what? March, 44%, 6%, 50-50 bet we get a rate cut. Folks, the reality is the bond market right now is already pricing in that rate cut. They already are. What's the Fed really going to do? Okay, but the fact of the matter is they raise rates quickly, and what? We've gone from 5.25% to 5.5% down to 3.5%. We're seeing rate cuts, and right now we're seeing after the Fed statement, to fight this back for up here, we saw a drop down here to base almost 3.5%. We're pricing in a 1/4 point cut, quick. Okay, so the point is that we're making policy decisions that are affecting the valuation of the dollar. Well, SLV, when did SLV bottom here recently? So let's go back, right? When did we see this kind of pair? We saw a bit of a pullback here in October, November, but guess what? Okay, we delivered rate cuts and what? And what? QE, right? We're buying bonds, we're reinvesting, and we're buying more. But if we go back here to August 22nd, that day right there was Jerome Powell in Jackson Hole. It's even more notable in GLD. GLD did nothing until when? Right there, August 22nd, Jackson Hole. The writing's on the wall, folks. What's the writing on the wall? Why is the Fed cutting rates? IV's high for SLV. Why? Why is implied volatility high for SLV? It's about demand, right? They're doing what? They're buying calls and puts on the margin. Now, again, at the end of the day, it's who's more willing to pay the ask or the bid, right? Buyers are more willing to pay the ask. This may be bouncing out a little bit. We got some closing trades. We need to talk about opening trades here, right? Opening trades. What are they doing? They're buying the ask, right? Yeah, they might be selling at the bid. Those might be closing trades, right? But think about it, right? Why is the Fed cutting rates? Why is the bond market pricing in additional cuts? They think we're in recession, right? At the end of the day, that's what they're saying. And the only reason why they're not cutting more is some fear over inflation, which, to be honest, is fading a bit, right? The month-over-month numbers for the last 2 months in the last report were actually pretty low, 1.1%. And again, I'm not one that says the Fed has any capability of managing, but the fact of the matter is you're seeing air come out of the balloon here, and we're seeing in the silver market. We're seeing it in the silver market, right? Because this is where the speculation is going, right? This is where all the fervor is going. And the options market is still, SLV, as Don talked about this morning, is a driver for silver. Is this going to go bust? Absolutely, it's going to go bust. Just like oil did back in 2008. Once we realize that all this credit creation the dollar destruction here, right? That's gone on since when, right? Last year we had the tariffs pop here. Oh, wait, no tariffs. Oh, wait, yeah, we're not, no, but yet we have the reciprocal tariffs. Then we have the April swoon. Why? Because the dollar did what? Dollar went up. In real terms, the dollar rose, right? What did gold do at the same time? I don't care what dollar did on a relative basis to other foreign currencies. But right there, we went boom for 3 days until when? We stepped in and boom, we started stopgap any sort of selling, right? We started promote the next bubble. Did we cut rates? Nah, but rate cuts we began to position towards rate cuts, and then we got the rate cuts beginning in August. Okay. So at the end of the day, I get it. I mean, I get that the Trump administration is trying to reorder things. They think they can create growth. But the problem is this is in the face of a mountain of debt that's been created over several decades. And I don't think you're going to be able to reorder that and not experience some sort of massive correction. Because again, once you start to dig, right, dig the hole of debt destruction, the hole gets dug and dug and dug. And all the money printing in the world cannot fill it up until we reach a certain critical mass. So again, is this the time to short silver? No, but you can. If you want to take a trade, yes, you can short silver. The reality is, how far is this going to go? I have no idea. But I talked about last week and the week before how to get long silver. Okay. So when you think the US dollar needs to be adjusted to a new currency, well, new currencies don't mean anything, right? Now, so if the government came out with their own currency, is that going to be better? No. Look at France post-revolution. They just found another currency to inflate and another currency to inflate, and they backed it by what? Real estate. All right, we're gonna stick it to the rich. We're gonna take their property and we're gonna issue new currency backed by that property. But it was the same people that were inflating away, thinking that there is a free lunch, and there's not. Yeah, no, I get it. But it's not going to make the numbers look better, right? At the end of the day, they're not going to remove dollars, right? What they may do with the central bank currency, they're just going to restrict how you use it, right? They can make you a savings-based economy because they'll say, hey, you can't spend it. And you can only spend it on certain things. That's central bank digital currency, right? Oh, here, we want to create inflation. Here's money. You've got to spend it in the next month. I mean, this is the reality. China did that, for example, right? They gave, you got paid in digital currency and it was tied, you had to spend it a certain amount of time. That was their wages. Yeah. I mean, the fact of the matter is even jewelers are getting hit in this market. They may own a lot of gold, but it is not a good situation for dealers or, for example, for even jewelry companies. But this will end. We talked about how to speculate, right? Take advantage. If they're buying calls, what happens to the call implied volatility? They're buying calls. What happens? The call volatility goes up. But guess what? They've been buying puts. But volatility skew is kind of dropping out here. But what are they doing? They're buying calls. So what you can buy? You can buy a 70. You can sell a 71, 72, 75. We talked about a 65, 70. We're almost to 70 right now. You buy spreads. You take advantage of the pricings. The options market is how you trade silver, but not buying calls, but just buy call spreads. Literally, we talked about earlier this week, buy a 65, 70 call spread. 60, 65, 67. Either way, spread it out to 70. We're almost to 70 right now. So what do? That spread right now, 65, 70. Let me expand the number of strikes here to all. That 65, 70 spread right now is what? We'll go sell the 65, buy the 70. What's the pricing at right now? I think it's like $1 something. You're up almost 100%. New currency, the silver dollar. Yeah, well, look, I mean, the fact of the matter is we don't need to have any debt. We don't need people to say what we can use for money, right? At the end of the day, we have crypto. We can trade gold. In fact, again, Your state may have laws that they've passed that allows you to use physical gold to buy stuff. And you say, well, yeah, who's gonna take physical? You don't have to trade physical. There's an actual bank you put your gold in, and you have a card you can use, and they transact at a price every day. I understand Don has a put on. You can begin, but is it reasonable to trade the downside? Sure it is. Right? But to me, it's like, this has been my take that all the silver, and we're going to look at it here in just a second, that all the silver puts that are being bought are just hedges. Right? They could be trades too, but they could be just hedges. So my thought is like, don't short silver, just be long silver, or take profits in silver. We close out our BTG trade. Gold stocks have not been performing as well. They've been limping along here, right? AG, silver company, it's been limping along here for the last month, right? It's not performing with silver. This is a purely metal, and the stocks ain't buying it, right? So if you're going to short silver, how do you do it? You short it in what? My preferred measure, looking at Hecla. Biggest silver producer, I believe, is Hecla. So for my stance, if you're going to short silver, trade Hecla. Because yes, silver is going to break apart at some point, but the weakness in stocks are likely going to be exacerbated. So if you're going to go bearish silver, I would look at going bearish Hecla. 20 Feb. Yeah, notice here's something as well. The vol skew is favorable, right? Instead of being flattish, the vol skew is more beneficial. 1917, buy deep and wide, 112 strike vertical. This is how this has been my choice for going bearish silver, is taking Hecla, right? Heckling Hecla. It's up to you, right? So rather than shorting the SLV, at some point it's going to be there, but if you're going to go SLV, go long SLV, right? Go long SLV, but don't buy this thing could wake up at 55 tomorrow, right? You cannot control your risk. Don't have the hubris of thinking you can buy equity in silver through SLV. Again, call spreads. 70, 75 for 20 Feb. Let's buy deep and wide. One more 4 strike. I guess span. Let's bump it out to 5. Sorry, $5. Cost you $1.75 today. Buying it at the money, 54 delta, right? $1. That's all you're going to risk. You have 325 of upside. But if you get to 75 tomorrow, you just sell this spread and move it out. Okay, move it out to 75.80. Right? I like to keep it tighter. I like to keep it $2 wide, but this thing's moving fast. $2 wide costs you 75 cents. Again, you're buying 62.1, selling 62.4, 62.9. There's a little bit of edge in here that you're creating in this spread here, right? 73 cents. Again, you get to 72 and above, sell that spread. You're not going to make dollar for dollar to move in silver, but you're going to do it in a way that you're not taking substantial amounts of risk. Solemn says, what's going to be the catalyst that makes silver fall? Well, at the end of the day, this is 100% about speculation, right? And who's fueling the speculation? The Fed's fueling the speculation, right? This is about the dollar losing value, which is helping gold go up, but the Fed feeding it through what? Lower interest rates, expanding their balance sheet to the tune of $40 billion a month. Well, guess what? It has consequences, right? When you add air to the balloon and you're trying to squeeze it in certain areas, it's going to pop out somewhere, right? They're trying to contain inflation. You squeeze more air to the balloon, it's going to pop out. It's popping out of silver. But once we realize that the debt that underpins all this stuff is about to crater, that's where the weakness in silver sets in. Go back to oil in 2008. This is the exact same scenario, right? Fed cutting rates, air in the balloons, trying to squeeze it, contain inflation, and what happens? It pops out. It's popping out of speculative excess in silver. What? Driven in part by SLV. So yeah, is there demand for silver? Sure. Are there obligations? Yeah, because people are scrambling to get their hands on it. Why? What's changed? That's the big question. And when we suddenly realize, that a lot of the debt that has built this house of cards right now starting to come unwound, the dollar is going to strengthen. That's where you're going to see the downside. But right now, we're getting crushed, right? GLD, it's up what? It's up significantly this year. It's up another 1%. Let's go back to our S&P 500 S&P sector ETFs here. Silver, gold's up 1%. Where's the S&P? It's basically flat. Gold's crushing the S&P 500 right now, right? Dollar's down 1.25% today. The S&P would be down a lot more if it weren't for the dollar weakness. Are we seeing that weakness against the euro? Well, this is relative, right? Dollar strength against the euro. What about US dollar / JPY? Dollar strength against the JPY. UUP, is it going higher? Yeah, it's higher today. Wait, how in the world? We're talking about weak dollar, gold's down, gold's up, dollar down? Yes, because this is relative between two different fiat currencies, between what? Europe and the US, right? The euro, 57% weighting to the euro. So yeah, we're beating the euro today. Beating the yen. Probably beating a lot of currencies today. Those currencies are fluctuating in value, aren't they? Is our economy probably better than most all the world? Yep, it is. Better than China? Absolutely it is. Okay, but the reality is we're starting to see a little bit of strength in the dollar relative to other foreign currencies. We're seeing gold strengthen today. That ain't good. Okay? What it's saying is the real value of the dollar is going down. The relative value of the dollar is strengthening. Now, if this thing really starts to pick up, what's going to cause the dollar to strengthen against the euro? Why would the dollar suddenly break out against the euro and we see this go down? What would cause that? It's debt, right? There's a mountain of debt that's denominated in US dollars in Europe. And suddenly when that debt starts to implode, there's a scramble for dollars. Okay, we're converting euro to dollars on boom. And those dollars, what? Go back to the debt. It's debt destruction, right? So the Fed right now is trying to engage in easier monetary policy. We're in a rate cutting trend versus a rate increasing trend. They're expanding their balance sheet through QE, not QE. And again, you're pumping air back into the balloon. It's going to have consequences. It's exactly very, very similar to what we saw in 2008. Who's going to break up? What's the next company that's going to break? I don't know. Is it going to happen? Don't know. But conditions are very, very similar to what we saw back then. But that's the catalyst, right? It's going to take dollar demand, which means what? Debt's going to start to turn. So we're bearish some debt stuff in Ghost Prince. HYG, we're bearish in HYG. I'm expecting this thing to break down here. Hopefully it does it in the amount of time we have. We have a February. Okay. I want this thing to break down here. We got an 80 put right here. Look for it to break support. We'll see. We're bearish, bearish mortgage bonds broke out this week, right? Speculative excess. I'm expecting this thing to roll. We got till March for this thing to break 10. So yeah, these are lottery ticket type trades, right? We're looking for a big move in the next 2 to 3 months. Hopefully we get it. Debt ceiling's coming up on 20. We got to negotiate a budget. So this is the problem, right? Is that, look, I mean, there are substantial risks. I mean, like you can say black swan. What's a black swan? You can't see it on the water, right? There's so many white swans on the water. The question is, there's so many potential risks. Yes, there's black swans that we can't see. So many potential risks. But when's it going to be manifest? Don't know if it's going to be. That's why you got to be a trader, right? You can't just be smoking just taking all the smoke of a bull market. Are we really in a bull market? We're in a bullish trend right now. Are we in a bull market? Really? You think we're in a bull market with the lack of breadth we've seen, and all of the market's gains are because of the dollar's weakness, that the S&P's significantly underperformed gold on the year? You think we're in a bull market? I mean, your view better be more expansive than just saying, oh, we're higher today than yesterday, so we're in a bull market. This is the reality. This is where the S&P's value in gold terms was It took 2.4 GLD shares to buy one share of the SPY. It takes 1.65 right now. And since that little reversal here in October, boom, the S&P is now lower than we were in October. We're almost back to April lows in real terms. This is a big deal. And I've been using this for a couple of decades now. You're finally starting to see people come around and talk about this more because this is a massive problem. This is not a bull market. This just says that all of your gains in the S&P 500 are by virtue of the grace of the dollar's demise. And what's causing this? Yes, tariffs are helping to cause this. It's accelerating what? The de-dollarization, right? Because if we're going to produce more in the United States, foreign demand of dollars, the foreign holdings of dollars are going to be less because we're not borrowing as much from China. We're not borrowing as much from Japan. Japan says they're going to buy some of our vehicles. Okay, fine, but they got dollar reserves, substantial dollar reserves. What's going to happen? If all of a sudden the trade balance, we start to balance out our trade, they're not going to hold our dollars anymore, which is perfectly fine, by the way. It is not necessarily a great thing to have the dollar as a reserve currency when it's fueled by debt as we currently stand. Bretton Woods was entirely different. It was based on dollar convertibility for gold. Okay, so this is a big, big deal that's going on right now. So again, it's just, but again, just realize that the risks that this represent are not insubstantial. Anyway. Okay, so just realize that it is not without risk and is very, very similar to other points where we've seen very similar dynamics and speculative excess to play out. And again, I think 2008 is a very good corollary, right? We just published a 4% GDP. Is that real? Did we really produce 4% more product, or are we just some stuff went up in price? The GDP deflator was 3.9%. Real GDP was not over 4%. Okay, so we can cheer it all we want. And again, you may like the policies that are going on right now, which I'm kind of with you. I do like a lot of the policies. And I do understand tariffs. Tariffs are not inflationary. Reciprocal tariffs, possibly. I don't like reciprocal tariffs, but I also understand we got to bring them to the negotiating table. They want a 10 to 15% tariff. Mentioned my brother at the beginning of this, a 10% tariff does nothing in terms of reordering manufacturing. It's easy for these foreign countries to absorb a 10 to 15% tariff. So as a good long-term rate, it's a good long-term yield, a long-term tariff rate. It's not going to be inflationary. But a 50% reciprocal tariff might be. But it does change behavior, and that's the intent. And changing behavior quickly also means there is going to be potential weakness in the dollar. That's what we're seeing. And the Fed's exacerbating it because of their poor policy responses back in the 2020s, and we're just going back here. Okay? But again, is onshoring manufacturing a bad thing? No. But it does mean less dollar reserves held by foreign governments, right? Okay. So we spent a bit of time here. So let's introduce. We're going to be breaking this down over the next week, and I'm going to be coming up with a list of 10. So Magic Formula 2026. All right. Right now, this is I may add some in here to consider. But what is the Magic Formula really about? Magic Formula is about value. Is value going to be a big deal in 2026? My theme last year was the Mag 7 companies were going to start to drag, and that gold would outperform the S&P 500, right? Those were two of my major themes last year going into 2025. That ultimately the dollar, again, gold would outperform the S&P 500, which it did phenomenally, and that Mag 7 companies would create drag on the S&P 500. If we do a ratio of Mag 7 to S&P 500, Mag 7 companies were able to make it back in that April to May timeframe. And post-Fed statement here, Jackson Hole did lead to a bit of a boost. So we began the year there. We're now here. So if we look over here, it took about 0.93 shares of SPY to buy one Mag shares. It's now 0.098. All right. So yes, Mag 7 did slightly outperform the S&P 500. I missed on that function, but here, look right here. It way underperformed going into the April lows. Okay, so I was right at the beginning of the year. And again, the Fed did what? Fed bailed out Mag 7 companies, right? And we went to the fact that they rose to about 35% of the S&P 500. My thought process is this for 2026. That still Mag 7 companies are overvalued. I expect Mag 7 companies to lag their traditional outperformance of the S&P 500 and probably will underperform. Am I expecting gold to underperform the S&P 500 in 2026 or outperform the S&P 500 in 2026? Actually, I am expecting gold to outperform, but not in the way that you think. GLD, I'm not expecting that 2026 will be a banner year for gold. I'm expecting the dollar to resurge. And if that does, gold will come in, but should outperform the S&P 500. So I do expect gold next year to outperform the S&P 500. Again, may not be as bullish as you think, because I do think we're going to start to see some of the risk filter through the market, and we're going to start to see a stronger dollar materialize in real terms and relative terms. Now, what does that mean for the market, though? Right? It does mean that the S&P 500 may experience some rather significant weakness. But it also means that we may not have the tailwind of the dollar's weakness to hold up and keep that speculative excess in areas of the market that are fairly unproductive. And AI, is there a more unproductive area than AI? Of course not, right? AI, there is very little in terms of revenue, cash, etc., right? And the premiums that you're paying for those companies are substantial. But every year I try to look at companies and look and say, okay, where is their value? So for 2026, 2025, these were the 10 stocks that I came up with. I modified my 12-week to be 252 trading days, which is 1 year. Okay. So in the last year, we're looking at 12 weeks. I'll just sort of by right here. BABA. So again, this is one of my value-oriented companies. BABA is up 79% for the year. Was up a lot more. Okay. We had a target price is actually 175. So back here down at 84, again, 161, 216. We had a kind of a fifth wave target of 175. We hit it. Okay. So if you sell into strength, probably did pretty well, right? SIMO, 61%. Our 423 is right here. I kind of redrew it. Anyway, 423% target was 84. We're not far off that right now, right? NUE. NUE is what? About 42% this year. I'm gonna have to back this out to see what we have a target. I think we're looking at 200 on NUE. Okay. Didn't quite get there. Up 42% this year. BHP. BHP is up 25% this year. Again, we're basically nearing our target levels here based on back here. Actually I did this one later, didn't I? Hit it in here. Anyway, but on the year, up 25%. So I've redrawn some of my lines since then, unfortunately. Tootsie Roll, up 22% since we began the year back here. SPY is up 16%. So did the portfolio outperform the S&P 500? The answer is no. Portfolio did about 10, I believe 10%. So 10, I think it was 10.8% was the portfolio's return over the last year. It's okay, right? Did we outperform the S&P 500 at 16%? The answer is no. But the whole premise of magic formula is you buy the beginning of the year, you sell at the end of the year. So I have a blog post in here that walks through the magic formula. I'm going to share with you. This kind of walks through the basic mechanics of what represents the magic formula. So I'm introducing it today. We're going to start to kind of look at some of these stocks as we go forward, but I'm going to share this with you so you have it. So I used to do an advisory before I came to TheoTrade. Did an advisory on the magic formula. principles. And again, I threw my own kind of biases into it as well. So it's not pure magic formula. I'm going to show you the criteria that makes up these 30 stocks. Okay. And it may not be that I may add some in here as I do some more work as we go forward, but we'll kind of talk about that as we move forward. But this is the 2026 30 stock list I'm starting out with. Okay. And then we're going to break it down. And we're going to look at these. So I'll throw my TOS watch list in here. You may like some of these, you may not. And stuff that's up a lot, I tend to not look at as much. AU is up 284% this year. Is this going to be one to look at for next year? Probably not. Okay, so we'll look at other things like valuation, but let's kind of dig into how we use it here. So Guru Focus. So here's my right here. Actually, I have it over here. Sorry. All right, so let me kind of walk through. So these are total of 30. So how did I come up with these? Now, when we go back to this is a really simple formula. And one of the things that I really love about this formula is that when you basically are looking at earnings yield and you're sorting by return on capital, you can actually apply a top-down methodology, right? You can really look and say, okay, what's the best magic formula stock in energy? What's the best magic formula stock in technology? So you could apply it however you want. But I added up more of a bottom-up element to my process here for this. But again, if you want to read this, again, this will walk through the exit criteria, the formula list. Again, this is an older one from when? 2020. Okay, the end of 2024, 2021. So let me kind of show you exactly what I'm screening here for. So for those values, for return on capital and earnings yield, I actually put in criteria. So I put in a value for the last year of 15% and for 5 years of 15%. That's the criteria I typically use for return on equity. Now, equity is what? It's assets minus liabilities equals owner's equity, right? And you go your equity per share, and then you factor in what? Your net income, right? Per share or net income divided by equity. Return on capital, this is all the capital that's invested in the company. You got return on invested capital, you got different measure. We're using Joel Greenblatt's return on capital measure, but we're taking investment capital, not just stock, but debt, et cetera, all factored in here. So we're looking for 15% plus because this is similar to return on equity, and 15% return on equity is a pretty good number. Now, what else am I looking at? Earnings yield. Well, there are different types of earnings yield. Classical earnings yield is what? It's just PE, the inverse of PE. But I've shared this to Garrett before. I like one of my favorite valuations to measure, valuation measures is EBIT to EBITDA, earnings before interest, tax, depreciation, amortizations. Okay, great. Well, the earnings yield of this is EV to EBIT, earnings before interest in taxes, but we invert it. We flip it around. It's EBIT to EV. What's enterprise value? It's stock, it's debt minus cash. It's the takeover value of the company. This is a much more relatable and comparable measure as opposed to PE. This is a little bit of a pulling back on debt depreciation, amortization, EBIT to EV. We flip it. I'm looking for at least 5%. How did I come up with this number? I mentioned I used to be an advisor. And again, 5% seems like a baseline number you should be looking for. And what's the inverse of 5? 0.05, 1 over X. That's 20. Okay. So in essence, if we were to kind of relate it to return on capital, it's again, we're looking for 20. So we're looking for what? Something less than 20, right? So again, that seems like a pretty reasonable number. That's not achievement. So we're emphasizing return yield. You could raise that number if you want. Price to book value. That's another bottom measure. Why would I put price to book value? Because I had over 100. Once I put in current ratio and quick ratio, I put in debt to equity of 0.5. I'm looking for companies that have lower debt and cash so they can pay their debt. right? So if we're looking for a debt problem in 2026, I probably want to look for companies that can pay off their debt, that can pay their short-term obligations, that doesn't have a lot of overall debt. So again, if I'm expecting the cost of debt to go up in 2026, I better be basically looking at the exact same thing for these stocks. So I'm looking at value, but I'm also looking at companies that can pay off their debt. They have the cash to do it. They have a lower debt to equity ratio, and they're generating returns. And you're not trading a huge price above book value. These are not less than one, but a less than a 3 price to book value, you're in a value territory. Less than 1, you're in extreme value territory. What's book value? It's assets minus liabilities. Assets minus liabilities. That is your owner equity, but the book value of the equity is your book value. All going back to equity, right? Assets minus liabilities. We're trying to reduce the liabilities, increase the cash, the ability to make our short-term obligations for the year, lower overall debt to equity, reasonable price to book, and some sort of yield. Okay. What else are we doing here? We're also looking at what? A 1 book value. Oh, sorry, 1 market cap, 1 billion plus. Okay. Yes, inflation has caused the stock prices to go up and market values go up. This is still on the smaller side, small cap to mid cap to large cap, mega cap, etc. So we're looking at all those. We're also excluding some things. We're only looking at US stocks. Okay. So again, if I'm expecting the dollar to go up, foreign companies, they're going to have negative currency pressures. And also the magic formula only looks at US stocks anyway. 33 selected on industries. What are we excluding? We're excluding financial stocks. We're excluding utilities. You cannot do traditional valuation analysis on those sectors. Bottom, period. And real estate, you analyze differently anyway. So what am I taking out? I'm taking out no preferred stock, closed-end funds, no MLPs, no trusts, no over-the-counter stocks, and they have to be optionable. So those are my criteria for creating and coming up with these 30 companies. Now, again, is it possible I could add a couple in here? Sure. But I'm gonna come up with 10 that I'm going to share with you, but I'm going to show you how I'm going to evaluate these stocks over the course of the next week. And we'll send something out, but I shared the list here for you. But I hope this helps just kind of give you a preface of what we're going to be doing next week at trying to build the top 10 value stocks for 2026. How are we doing, Johnny?
Oh, we're doing all right, Brandon. How are you?
How was your Christmas?
It was good. It was very festive.
Were you guys warm or cold?
Mild.
Mild? Okay.
Yeah, mild.
We were 60.
Is that warm for you? Because I know you guys, because of the mountains, get some,
We're usually about 40.
Okay, so that's
average
warm.
temperature for December is 43. Yeah, 60 is like a record. So we're gonna have a record year this year. It's a La Nina, so we tend to get delayed snow.
Okay.
So usually January. But I remember back in the Olympics back in 2002.
Yeah, I remember
there was like no snow.
Yeah.
And then 2 weeks before the Olympics, we just dumped.
Yeah, wow.
And of course, I work for the host broadcaster, and they did not map out because there's no snow. They didn't map out the cable line, so we had to lay a bunch of cable.
Oh, that's fun.
And that was digging up a lot of snow of the tracks and everything, just digging for.
I can imagine. Yeah. So are you a dollar bull going into 2026?
I am. I think the credit cycle is going to start to feel the strains.
Yeah.
And I talked about today why silver's move. It's kind of similar what happened to oil back in 2008 and other points where you see that run in commodities. Again, nothing's for certain, but this is partly Fed driven. This is financialization driving this, less so than maybe just industrial demand.
I will say this, I didn't have much expectations for silver above like $50 this year. So I mean, this is I'm honestly at a loss of words. Like, you can't really do anything. You can't sell because it's going parabolic. You can't buy because then you're chasing. You just have to sit back and just spectate, I think.
Well, I think the only trade on silver, and I went through this the other day, and it's already towards the short strike, just call spreads.
Yeah.
Skews in your favor. You risk, you get about 3 to 1, at least 2 to 1 reward to risk.
Yeah.
And if it collapses, okay, I'm done. But you have to risk it all.
Yeah.
Because the move down is going to be ugly at some point.
Oh yeah. I'm with you.
Yeah.
Cool, man. Well, enjoy your weekend.
All right. I'm gonna do the 10, 11 hour drive to California here in about an hour. So
Oh, good for you.
fun stuff.
All right, man.
I have a good
See
one.
you
See
later.
you.
All right, Theo traders. We are live. Welcome. It is Friday. It is